Thanks for y'all tuning in today. This is our YouTube channel that Alex has for First Heritage Mortgage. Every week, Alex or I record a YouTube video and give a newsletter out talking about mortgage financing and mortgage topics or mortgage products or rates. We always try to bring up rates a little bit. But before we get started, we want to make sure everybody realizes we are with First Heritage Mortgage. We're in Kitty Hawk, North Carolina. I have to give you my MLS ID number, which is 589370. And Alex's MLS ID number is 1615455. Today, we've brought in Nick Graham to talk about insurance. Nick works for Standard Insurance here on the Outer Banks. He's been in the insurance industry now for about 7 years. How long you been in, Nick?
Yeah. It'll be 7 in November.
Right. And Nick grew up on the Outer Banks. He went to school with Alex, just a couple of years older than Alex. I think he's between Alex and Wynn, aren't you, my oldest son?
Yep. Wynn's just
Right?
a hair older.
Yep. So he went to UNC. He's a big Tar Heel fan, I hope. He decided to come back to the Outer Banks and practice insurance here. And we work with Nick a lot. We send new clients. He sends us clients. He's a great person to work with. So we normally talk a little bit about rates. So before we talk about insurance, let's give you a quick rate update. Rates for the week are up a little bit. We like to follow this thing called the 10-year Treasury. And the start of the week, it started looking like it was going to come down and give us maybe a little bit better rates. Of course, the Dow lost about 1,000 points on day one, Monday, and then it rebounded back the following day. And of course, we lost everything we got in rates there. So there's really not a lot of change. Rates for 30-year fixed rates on primary residence are still under 7%, probably about 6 3/4. We record this on Wednesday. You'll listen to it Monday. So certainly rates could have changed by then. Our best rates are something like a 7/1 ARM for second homes and investment properties that are priced in the low sixes, like 6%. All these rates we quote have no points. So, but let's get into the topic of insurance. We've got Nick here as our local expert to tell us about insurance and what we think about it. We are hearing from consumers about insurance as they talk about buying houses. It's all over the internet about the cost of insurance in different states. I would say we're not the worst state here in Carolina. It's mostly the coast that seems to be affected by these higher premiums. When you talk about premiums that are in excess of 6 or 7 or up to $30,000, depending on the house, whereas in the middle of the state, premiums are more reasonable. You can probably insure a $200,000 or $300,000 house for less than $2,000. But here on the coast, just about anybody's insurance premium is $5,000, honestly. And so that's a lot more. It's more than 50% more. It's 100+% more. And as the houses get bigger, and our houses generally do tend to get pretty large as that we finance, the insurance premiums go up. And I'd say on average, our premiums that we see today are well in excess of 5. They're probably closer to 8 or 9. And so we're going to talk about that a little bit. We'll compare it maybe a little bit to other states. I'm in Florida a lot, and I'm in Florida today. And here in Florida, it's a big negative around real estate and sales today. And premiums are really high, but they're a lot higher in Florida than they are in Carolina. So when you talk about it, we're lucky that we don't have some of the issues that Florida has. So that's our topic. Alex, I'll let you sort of ask a question of Nick. I'm supposed to be the moderator today. This was Alex's idea to have Nick on. So take it away, Alex.
Well, yeah, thanks, Nick. And I think just to circle back to some of Drew's points, I think one of the first points he just made was the typical premium is around $5,000. I think that's a little high. Depends on the price of the property and replacement coverage, but that would be just for people thinking about it per month. It'd be $416 a month. But I just want to hear Nick's opinion because he's the one that's writing insurance every day. I just kind of curious.
What do you see for the average premium?
Well, a lot of it depends on like a couple things like obviously size of the house, replacement cost, location, age of the house is huge. Roof age is a big thing. But kind of a general rule of thumb I've found to be productive and useful the last couple weeks is it's about like $1,200 per $100,000 worth of coverage. Maybe 1,100, maybe 1,000. So if you're buying a house and you think the replacement cost is around $1 million, I would definitely budget at least $10,000 in insurance a year. I think that's a good rule of thumb. So kind of just go up and down from there.
So when you talk about structure value, the house, so the house is worth, $300,000. That's $3,600 in premium. It is better than I would have thought, to be honest with you. For a $300,000 house, although we don't have many houses that are just $300,000, but we're using that as an example.
No.
But what was the point I was trying to make is like, how do you get that value? Do you use tax value or how do you determine the value you're going to insure? That's what the question I was coming up with.
Yeah. So, I mean, there's a couple methods. I kind of try and stay in touch with like a couple local contractors that I work with down here, like kind of just go from, Corolla down to Hatteras. Right now I'm not quoting anything below $250 a square foot. I'm kind of in that $250 to $300 a square foot range. Older house, probably $250, newer, nicer house, $300 a square foot. But most of the stuff I'm just using like around $275 a square foot times the square footage, and that's where I get it from.
How do you get the insurance company to accept that number? Like, do you have a letter from a licensed contractor, or how do you get them to accept that number?
No, I don't have a letter. There's what's called like a replacement cost estimator. It's a tool that we use that can kind of like, that's changes with building values, building prices, construction costs, stuff like that. And that kind of can help like reaffirm what we estimate. But, really it comes down to what the insured is comfortable with. We really just like make recommendations. I think 275 is a pretty good number, maybe a little more expensive in Hatteras and a little more expensive in the 4-wheel drive area. But that's how we do it. We make a recommendation. We have the replacement cost estimator to back it up and then kind of just go from there.
So if you got a 4,000 square foot house, you multiply it times 275, that's a $1.1 million house.
Yeah, absolutely.
Right.
Yeah.
And I think that's 11 times 1,200. Is what you take 11 times 1,200 and you'd have a premium that's $13,200.
Yeah.
I think,
and that, and honestly, that's not including flood either. I mean, that's just like wind and hail and fire insurance. So.
Yeah.
Right.
And I think another good point to make for a second is that if you're relatively a new constructed home, or if it's new construction, the premium that Nick is kind of suggesting what it costs, it can be 25% cheaper. Don't you think, Nick? Like, it'd be quite a bit cheaper.
Yeah. Newer houses are definitely more insurable, and you can kind of, get a couple discounts, and like, they're just, you get a better rate with newer houses.
Could you drop it down from, say, that 1,200 per 100,000 to 1,000 or 900?
Yeah, I would probably 900 to 1,000, something like that.
Okay, well,
I agree.
That's a substantial savings.
It's notable because when I'm doing the construction loans, obviously the future homeowners insurance cost is really important for my client to qualify, and I always have to get a quote. And I'm used to quoting on purchases, what you're talking about, that type of higher premium cost. But I've noticed when I do the construction loans, my DTI is really tight. I don't need to put in a huge insurance number. I can be a little bit more, optimistic about having lower insurance costs and getting that DTI where I need it to be. I found that to be true a lot for new construction specifically. It's a lot more affordable.
It's worth noting what Alice is talking about. We have to count the insurance premium payment amount. If it's, $500 a month, that's in the payment. That's in your qualifying debt ratio. Exactly. No matter how you cut it, whether it's an investment property or a second home, we got to know those premiums, and they have to be accurate for underwriting to really consider them. I think what's interesting in this conversation that I take away is that, a few years ago, pre-COVID, you could build a house for $150 to $250 a square foot. And everybody wants to know why insurance premiums gone up. And honestly, this is because the insurance companies were insuring houses at $150 to $200,000, $150 to $200 per square foot. They went up. They're still paying. People are still paying these lower premiums, and they had to catch up, and they really jacked the premiums up to try to get caught up. And we are, even though Florida has had a really bad term with it, and there's some issues we can talk about that specifically. But I think this is also true in North Carolina. I think the premiums have caught up a little bit, and so the increases going forward will be smaller. Don't you agree with that, or not?
Yeah. No, I think so. I think like probably like 3 years ago, we had like a huge jump, like 20-25%. And it's, it's kind of stabling out now. Just like an example, like last year, all the insurance companies asked like a 45% rate increase in our area. And then like our insurance commissioner kind of fought it, negotiated down. So now they went from 45 to we're getting 10% over 2 years. So it'll be like 5.5% this June and then 5% the next June.
A more reasonable number. Right.
Yeah.
Right. So one of the things that I've always thought was, at least I'd like to see, and that's just like my dream idea, is why doesn't somebody or some political group or some group of people come together and create essentially a cooperative that's not a nonprofit to insure an area or a state or a region? Like we could do North Carolina and Virginia together. We're somewhat similar as far as our cost and structure and culture and lots of similarities. We could have a cooperative between these two states, and this government or somebody, could put in a big amount of money, and then we could all, not have high paid insurance executives. That's another tyrant about how people are overpaid. What prevents us from doing something outside the box to do insurance instead of always just, hey, the insurance companies run it, there's not a lot we can do? Why don't we do this?
That's a good question. I think, it's probably just like legally and just like getting it all done. I mean, it's probably just some huge hoops to jump through. There is precedent, like one of our insurance companies, Builders Mutual. They insure a lot of contractors. They were created by like a group of contractors, and they're kind of still like stock owned more or less. Like they give out dividends back to all their policyholders each year. So there has been like precedent in doing it. I think it's probably just finding someone to like take the jump and like commit and like really like, figure out the way to do it, with all the
I'm going to just tell our
stuff.
audience, if there's anybody watching this video that wants to help create a cooperative, I'll quit my job in mortgage that I've done for 40 years and go run it for you and take virtually no salary. I don't want to be a big compensated insurance executive. I just want to help the community get better insurance premiums. It seems like that would be
it's a
really
big factor. Insurance
solution.
cost is a huge factor, and also like you're talking about replacement cost coverage, has gone up. The cost of materials has gone up, and it's a big reason why people have a change in their policy, and then all of a sudden their homeowners insurance went up significantly by 25%. They've owned their home since 2018, and it's a big reason why people might end up selling their house, for example. And obviously that's not real. We don't want someone not to be able to afford the cost of a home due to insurance. I think that's what Drew's trying to highlight there. Right? Don't you think so, Drew?
Yeah. I mean, I just seems like to me we should have an alternative to just the corporate running of it. It's still, it wouldn't be a for-profit organization. You'd have people that work there that have to get paid, of course, but the ultimate goal would be of the company would be to give lower premiums.
Right.
They used to do a lot of cooperatives back in the day. There was a cooperative for health insurance in the state of North Carolina back in the 60s before they created Medicare and stuff like that. It's just a different way of trying to bring costs back down. So do you see, we don't, I mean, at least we don't really, I see people occasionally, but I mean, it's pretty rare that somebody decides not to buy a house because of insurance. Do people talk to you people and go, heck, no, I'm not buying this house. This is just too much. I mean, do you see that at all or much?
No, I don't. I don't. I think that like a lot of some real estate agents have like asked me to like kind of help them like on their listings to kind of like do like a pre-quote to kind of just like give someone an
Hmm.
estimate of what it's going to be. So it's nice that they kind of at least have somewhat of an idea going forward. I think there is some sticker shock sometimes, especially like out here on the Outer Banks, but I've never seen anyone that like wanted to buy a house did not do it because of insurance. There's some ways you can play around with coverage and deductibles to get it lower, but I've never actually seen someone like pull out of the deal because of the insurance.
Yeah. I mean, I'm just to echo that, like, and I mentioned this a little bit earlier on a previous call with us, but I had a client that owned a house since, mid 2015 or so, wanted to refinance in 2021, 2022 area. Um, in the refi, I have to provide insurance coverage that replaces the cost of the home. His previous coverage did not replace the cost of the home. It was underinsured. And so when he went through the process of refinancing, I had to increase his premium. And during that process, he definitely was very upset. One, as insurance costs increased
Yeah.
so much, and that's due to the cost of materials, replacement cost, but also I had to really find a solution that was workable because it almost did talk him out of the refinance, Drew, because it didn't save him enough. He was like, I'm replacing a payment with a higher insurance. I mean, it did have the benefit if something
Yeah.
went wrong, right? But, it was very hard to talk him into the refi, and I had to really be creative on it. It was just
Did you get his
interesting.
premiums down from the initial quote?
I did get his premium down.
Right,
Yeah.
right.
But that was in the refi boom. That loan took at least 100 days to close. At
Yeah,
least.
when I did my insurance last, Nick wrote my insurance. By the way, everybody who's watching this, I've used other people on the beach. I certainly love people at Nationwide, the Midget Group, Southern Town Insurance. We're not preference. We're equal opportunity. Whoever you want to use. But Nick wrote my last insurance, and one of the things I did to get my premiums down was raise my uh, AOPs, all other perils, isn't that what it's called? So
Yeah.
tell us what
Deductible.
those are. Tell us ways to lower your premium. What's the bare bones so you can get that $1 million with your house's worth?
Yeah, I mean, the easiest way is raise your deductible, which is obviously like the amount you pay out of pocket before the insurance kicks in. So that's kind of like the easiest, like low hanging fruit. Say you have like $1,000 deductible and you want to increase it to like $5,000, then I mean that's like the easiest way to drop it like $500, $600, maybe 1,000. That's what we did for you. That's a big way.
You could
There's
also
other little
increase it
things
by
like
percentages. Like you can go as high as like five
yeah.
percent if you want to, which on $1 million property
Uh,
is fifty
I didn't know
thousand
that.
dollars.
I
Right.
didn't know that.
Which is, I mean, yeah, and like you're getting into self-insurance at that point, I mean, it's like that's a big deductible to pay, but it's I mean, it helps, and a
It's gonna
lot of
save
people
you
are willing
money.
to do that.
I
Yeah.
think I
Yeah.
chose a pretty high percentage element in mine. I just want people
Uh,
to know that you can do it as a percentage, especially for the wind and hail portion by itself.
yeah,
And so,
yeah,
that is the other thing we should tell people is that you really have two policies. You have a wind and hail policy, which we don't call it hurricane insurance, but it basically covers that, and that's the biggest part of your premium. And
yeah.
it isn't who writes this type of policy for us most of the time.
Most time it's like a state. It's actually like a state-run fund called the North Carolina Insurance Underwriting Association, and it's
Hmm.
like a legislatively, what's what I'm looking for, like backed group that exists to write coastal property coverage in North Carolina because it's almost like the insurer of last resort, but it's kind of the only insurer, and they actually do a really good job. I mean, they're not like crazy expensive, and it's a good little insurance company.
Is people like Frontline or anybody at all writing wind and hail?
Yeah. Frontline's writing some stuff. They're competitive on like the bigger homes. Once you get over like 1.5 to $2 million, the bigger stuff.
And they want
They've
new.
kind of
They want
they
new.
have yeah. They want new. They
They
have
won't
strict
know.
underwriting guidelines. And then there's
What's
some
new?
excess
What's
and
new to
surplus
them, Nick?
markets too.
What's new to them?
Um,
What's that mean?
I mean, probably like 2015 and above. Right, like right now, I mean, it's like if your roof is older than 15 years, 20 years, if your roof is older than 20 years, you're going to have to buy an expensive insurance policy. That's kind of like the big buzz thing right now.
And
even if you got a metal roof, because metal roofs should last longer.
Even if you have a metal
Even if
roof,
you got a
it doesn't matter.
Yeah, even if you have a metal roof, sometimes they'll make an exception, but like really, it's just a flat 20 years. Like those are the guidelines. Once you if you get it in at 19, they don't like mess with it. But it's just if you're over 20, they put a red X next
So
to
you write the wind and hail policy, and what's the other insurance? What's that cover? And do you write that with this North Carolina Joint Underwriting Association, or do you write it with somebody else?
Yeah. So like the other one is like kind of like your fire, your water, your liability, smoke, stuff like that. It's typically like a homeowner's policy that excludes wind and hail. I write a lot with Markel, American Insurance Company. They're actually out of Richmond. They're really good. The North Carolina Insurance Underwriting Association, they do write some homeowners. So I kind of save that for like older houses that maybe aren't as updated as the newer ones. But I mean, a lot of it is through Markel. So they're really just options are limited down here.
I always look at Zillow or Realtor.com and see the age of the home, and of course, most of the time, if I look at 10 homes, 8 of them are older than 20 years old.
Yeah.
And my hope is that the agents will put in the listing notes, essentially on Zillow or Realtor.com, how old the roof age is. It allows us to, Drew and I, whenever we make an estimate, because we do make a lot of, kind of like preliminary closing cost sheets that provide, cash to close and provide a mortgage payment. And we're, a lot of times we haven't contacted the agent yet. And like Nick said, one of the things he's done in the past is, for the listing, a preliminary quote. And that would be really helpful to help people browsing for property to know that this insurance policy on this particular house, even though it might be built in the 90s or 80s, has a cheaper premium than potentially another home. I think that's just one thing to note for consumers browsing property. It's a big difference in the insurance premium per month, as Nick's trying to express here, if it's an old roof versus a new roof, just flat out. It's a big difference.
Yeah. And I would make sure that like even like make sure they have a new quote, because some people I've seen like they have the previous owner's insurance, which might be like they insured the house in 2010 and like it's way underinsured. So like when they actually get the actual quote, they're like, oh wow, like that's like double what the previous person was paying. You're like, yeah, well, their house is insured for $150 a square foot. That's just not going to work. So
so speaking of that, that's one of the major things I wanted to mention is that in 2018 and 2017 and 2019, and Drew's done this a long time, I'm sure for him, we used to see people assume policies. It was much more common to have that conversation. I haven't seen someone assume a policy in the past 2 years for sure. Not one. And is my reason to mention that is that the reason why is because it's just not possible because the replacement cost coverage is too, not enough, essentially not high enough coverage.
That's one of the reasons. So really flood is like the only assumable policy, and they kind of restructured how they rate flood a couple years ago. So like honestly, like sometimes like if it's an older flood policy, it could be like more expensive than just writing a whole new one.
Let's talk about flood insurance real quick, because obviously if you're in a flood zone that requires flood insurance, and that's every zone except X. So if you're in an X zone in anywhere in the country,
isn't there XE? XE doesn't. I think isn't there another one?
There's an X500, I think.
That's what I'm talking about.
Still like,
it's still. I still think
that's not required.
Right. So if you're in an X zone, you don't have to have flood insurance. But if you're in any other zone, which is zones are some like AE, VE, I think there's just a V zone. What are some other?
The main ones we see around here are AE and then just the VE.
Right.
VE is normally reserved for like oceanfront. AE is more like kind of sound side interior.
Right. VE basically means the water's going to come through with more violence, more strength.
Yeah.
and the AE is more passive rising water. So,
Yeah.
but how much coverage do you get with flood insurance?
The federal maximum, so there's like, if you're buying it through the National Flood Insurance Program, which is a FEMA-backed flood policy, the maximum you can get is $250,000 for the building and $100,000 in contents.
Right.
If you want to insure it for higher, we can write what's called like an excess flood policy, which will go higher. But the 250, 100 is the max for like a federal flood policy.
So from our standpoint, that's all we require. You don't have to get more insurance, but you can sell them more insurance if they want it. And what is that extra insurance super expensive, or is it about the same as what a 250 policy is?
It's honestly like really depends on where the house is located. Like say like if it's like a really expensive like underlying policy, like the federal one is really expensive, then like it's kind of the next levels are normally a little cheaper because they kind of like bridge that gap. But if it's like a medium cost, federal one, then it's kind of can be a little more expensive.
So if you're AE, do you pay the same price as the next guy that's AE, or how do they determine if everybody in AE pay the same price? Or
no, like so they used to like base it fully on zone, but about 3 or 4 years ago they started the National Flood Insurance Program started rating each house like according to its risk location. So they like rate each house specific to like where it is, how it's built, how it's elevated, any claims. Like really, it's like it's on a per house basis now. So like I've seen that like a lot of the VE like oceanfront homes actually like their premiums decreased by half, whereas more of like the soggier, maybe like interior homes close to the sound, they got really expensive. So it was kind of
is that because of like there's this thing called an elevation certificate you get with every house that tells you where the insurance basically begins? I think like this elevation certificate says the first floor is here, and isn't that where the insurance begins?
Yes, actually, so you don't actually need those anymore. When they changed the laws, like you don't have to use it to rate anymore. But I think really they just looked at it. Yeah, no. But they're still helpful. They're still really helpful. I think they just looked at like it from like a risk standpoint, and it's like the oceanfront homes really don't get flooded around here. It's really those ones on the sound side. I think they just like actually looked at the data.
Well, I'd like to wrap this up. We probably talked long enough for people to listen to us and want to watch. We're not quite at the popularity of the All In podcast yet, but I want to thank you for being here today. I would say one thing about flood is there is the opportunity to get yourself out of a flood zone. You can do this thing called a letter of map amendment. We refer to it as a LOMA. If you're in a flood zone that you feel like you shouldn't be in, because your property's got a higher elevation than really the maps might indicate. It is the property elevation. You can't build out of the elevation and say, I want a letter map amendment. You have to, the property itself has to be the elevation, the right thing. So I have seen people do that specifically in the 4-wheel drive area. We didn't talk about insurance up there either. It's another topic. We could go on talking about insurance.
Yeah, there's a lot more, but we got to preserve Nick's time.
Yeah.
We'll have to circle back.
if you ever, need Nick, you can Google him, Thunder Under Standard Insurance. We'll be glad to get his number and email address if you call us. If you want to start an insurance cooperative and put in a couple of $1 million, give me a call. I'd be glad to start one up with some wealthy investors on the Outer Banks and cover something like that. But I want to thank you for your time today, Nick, and I hope that we all have a great summer, and we're looking forward to it and see you around town, man.
All right.
Yep. Thanks, you guys. I really appreciate it. Yep.
Catch you later.
Thanks a lot. Have a great day.
Bye.
All right. Bye-bye.